Okay, good morning once again, and apologies for the delay. I think we have enough people on the call now. We can actually start. Um, we welcome everybody to the September edition of the Black Star Market Color, and we are excited to have you all join us this particular month as we delve into key market trends and then also updates we have for you. My name is Ernest Edu Owusu, and I'll be moderating the call for today. Our presenter goes by the name Sunkari Enoch, who is a member representative from our research and analytics team. He will be taking the presentation today. A few things we should expect from the presentation. So we are going to begin with a broad macroeconomic updates covering inflation trends and then also currency performance. We would also delve into the capital markets updates, which we would cover prevailing interest rates, government securities, and then also equity trades as well. We will do a deep dive into Ghana's banking sector, which is the main focus of the presentation today. We are going to talk about insights on total assets growth, deposit lending balances, loan quality, and investment patterns post domestic debt exchange program. Then we would finalize with a closer look at how the banks are navigating current fiscal policies, credit challenges, and then also evolving market conditions. Throughout the presentation, we encourage you to jot down any questions you might have. There will be a dedicated Q&A session immediately after the presentation where the presenter would be available and the entire analytics team would be available to address any questions you have. If you have any reaction to the presentation as well, you have the liberty to also air your views. You can share your reaction or contributions as well. You can do so after the presentation by lifting your hand up for you to be called and unmuted, or you can just suggest it in the chat box or the Q&A box, and it will be read accordingly to our people to answer. Additionally, we are going to conduct a short anonymous poll after the presentation to gather your feedback. So please stick around for that as well. Once again, welcome to the September edition of Market Color. Let's get into the insights today. So I would invite Mr. Enoch Sunkari to take us through today's presentation. Sunkari, confirm if you can hear me loudly and clearly.
I can hear you. I don't know whether you can hear me too.
Yes, I can hear you. So you have the floor. You can proceed with your presentation. Thank you very much.
Oh, thank you. Hi, everyone. Welcome to today's session of the Broadcast Market Color. I am Sunkari, and in today's session, we'll kick off the broad update on our market and we'll wrap it up with a closer look at the banking sector in Ghana. There's been news surrounding rising non-performing loans and other stuff within the banks. So today will be the time for you to get some of the answers. So stay tuned. Hopefully you get the answers from this session. Thank you. To set the table, I want to start with inflation, because that's pretty much one of the challenges we have in this continent. Because I sometimes call inflation the hidden tax, because it takes some part of your money when the government is not yet in to give you the actual tax. So when you look at your investment and salaries and almost everything, inflation has a way of taking part of it. It just comes in and take it before even governments have to come. And has become one of the challenges across all major economies, both developing and emerging markets. And in Africa, we are part of the smaller group of people having the hardest hits. So, however, when you look at inflation across the world, especially in Europe, Middle East, and Africa, that's emerging markets and developed markets. In 2024, inflation is actually expected to cool off. So when it comes to Europe, inflation is expected to fall closer to the European Central Bank's 2% target, which is to be driven largely by lower energy and good prices. But there's a catch here. Wage growth and then persistent price pressures in some sectors in these economies may also lead to inflationary risks later in the year. The ECB may take some conscious stance to gradually lower the interest rates while monitoring the wage dynamics to prevent further inflation spikes. So when you come to the Middle East and then Africa, inflation is more diverse. High energy prices in some of the oil exporting countries have been a source of inflation, but as global energy market stabilizes, inflation is also expected to ease down. However, in certain regions, supply chain challenges and domestic fiscal policies would also continue to pressure prices. But when it comes to the developed markets, let's say US and in the UK, inflation is also anticipated to moderate. These economies are projected to cool, leading to more balanced inflation trends. Back home here in Ghana, inflation decreased to 20% in August. That was down from 20.9% in July. This marks the consecutive month of decline, which was driven primarily by a reduction in food inflation, which dropped to 19.1% in August. On the other hand, non-food inflation increased slightly to 21.5%. But when you split it across the various regions, Upper East region recorded the highest inflation rate at 27.8%. Upper East is just a small place, but having high inflation this much is really something we have to look at, because that's the place we're supposed to get most of our food and other stuff from, which will help tame food inflation. While when you look at the Northeast region, it had the lowest at 10.1%. This reduction is a positive sign for Ghana's economy, though inflation still remains significantly above the central bank's medium-term target of 8%. But here we expect that inflation to let off its steam in the light of tighter monetary policies and fiscal measures as we are even under the IMF program. Hopefully, we hit the 15% projection by the central bank this year. Despite these efforts, inflation rates it still remains, but this is because of the election-related fiscal pressures in the months ahead, and then maybe some global economic uncertainties that may come. We are not wishing for it, but if it comes, we'll have to face it. I really wish we ignore a discussion on the state of our currency, at least just for today. But I think we can't, since that's kind of like the elephant in the room. So let's get in. Our currency, that's the cedi, has become so hot. And at this point, personally, I think I should be the only paper that leaves the Bank of Ghana's printing room with a warning label or a sign on it. Handle it with care or risk third-degree bias or something just similar, just to be fair to its benign holders. In the past years, where the cedi has faced significant depreciation against the greenback, that's the dollar. When you look at it as far back, not even as far back, just a few years back, let's say in 2020, the cedi depreciated approximately by 2.9%, and in 2021, it depreciated by about 5.1%, and in 2022, it worsened by 39.1%. That's a lot. And in 2023, it weakened further by around 15.1%. And here we are in 2024. The story hasn't changed. Even at the time we got into an IMF program and having received several forex inflows, it got even worse. Almost 9 months in this year, and the cedi has about 23% is chopped off the cedi. And when you narrow it down, you will look at when you narrow it down to quarterly, the cedi only fought back in 3 quarters. Now, like since 2020, that's the green portions of the chart. So it's kind of like I just have to ask the question again, even though we've been asking the same question and then we keep getting answers that don't work, or we don't really get the actual answers. So what is actually the actual problem that we are facing in this country? Or is there something else beyond us? Is it our economic policy choices? Is it high inflation or trade deficits? Or even let me even extend it to the global perspective. Is it global economic conditions that are still not giving us the chance when the rest of the world have moved on? Well, I think your case is as good as mine. in the coming months, I expect a bit of moderation, but not at a significant deceleration pace as we are faced with elections and global uncertainty risks. Since December is the only time to hold CDs, because when you look at the chart, the only one that the CD experienced a bit of appreciation in is in the past 2 years is December. So maybe December is the only time for you to try to see whether you can have you can hold onto the CD. But history don't always repeat itself. Hopefully, we expect it to hopefully repeat itself. But if it doesn't, we'll keep hoping. And now to our T-bills interest rates. Our interest rates have been trending downward this year as this is as a result of the government's continued efforts to stabilize the economy and control inflation. The government introduced a pricing guidance system in the last few months of 2023, somewhere in November, to bring rates under control, at least to favorable levels. This is part of the broader strategy to reduce inflationary pressures and support economic growth. I think this was at a time when the rates were hitting the ceiling. And those for the various tenors, that's a 91, 182, and then the 1 year papers were going for 30% on an average in the primary market. In the same breath, rates were so low in the secondary market, and everyone was locked in. But when the pricing guidance was introduced, investors flooded the market and then larger volumes were traded. Perhaps that was an attempt to exit their positions and lock it in the primary market because the risk on the primary market was increasingly high. Or maybe just to exit as uncertainty risks were heightening among investors as to what the pricing guidance was actually meant for. And then this pulled the secondary market yields up across the various tenors and the spread began closing. So when you look at the 91-day bills, they began the year at around 29.2%, but have since dropped to approximately 24% per the as of the last auction. You see, when you look at the spread between these rates, the primary market rates and then the secondary market rate, it has significantly narrowed, leaving only a small margin. It even got tighter in the last weeks of August. When you look at the tail end of it, you realize that the gap has significantly closed and narrowed, almost getting to the level just 30 basis from the primary market rate. And it is no different for the 182-day bills, because when you look at the 182-day bills, they also began the year around 31.7%, but have also since dropped to approximately 27%. And look at the spread between the secondary market rates and then the primary market rates, it has also narrowed, but remains a bit wider until the last weeks of August, and it closed, leaving just few bits to be at par with the primary market rates. And when you look at the 364-day bill, it also started a year around 31.7%, but also has also since dropped to around 27%. And the spread between the secondary market and the primary market rates have also narrowed eventually, and even assets also started tightening in the last days of August. And rates are expected, when it comes to the broader expectation and outlook, rates are expected to continue to drop in the primary market. But when you look at the recent undersubscriptions of the auctions, poses the risk, and risk may remain at the current levels or even inch up for a while to test the appetite of investors. So I think with the pricing guidance, when you look at this few discussions, the pricing guidance really impact rates. I think obviously yes, it got risk declining, though they are still high when you compare with other countries. For instance, when you look at just Nigeria, just here, those are cleared. The 364-day bills are cleared around 23%, when our bills are still cleared at around 27%. And I think that we still have a long way to go. Even though rates are dropping, for the year up until August 2024, the market trading volumes also doubled with about 99% increase to 103.2 billion compared to the same period in 2023. The treasury bills continue to dominate the market due to their perceived safety and ongoing economic uncertainty. Obviously, the short-dated papers, well, just to lock in and get out within the short period. So that's why I think that's why there's a lot of traction on those papers. But despite some fluctuations in the weekly volumes, the overall trend points toward increased liquidity and investor confidence in government securities. I think this robust performance signals the demand for safer assets, especially the treasury papers, as the economy stabilizes just after the crisis we had. And at the primary market, government options were up earlier in the year, especially the first 2 months until the introduction of the new cash reserve requirement by the Bank of Ghana in March, where the volume of bills accepted in the treasury bills auction decreased in April because the banks needed to squeeze out some money, some cash to meet the new reserve requirements, and then they weren't able to fully participate in the auctions when the new CRR was announced. I think though the participation at the auctions picked up again, interest rates have shifted. The interest have shifted to some of the short-dated papers. That's the 91-day bills. For 2 months in a row, July and August, government couldn't meet their targets, even after rates were raised a bit to test the appetite of investors. After the earlier weeks of low participation, I think investors are still pulling back. Is it because of the uncertainty in the elections ahead and investors are not willing to roll over anymore, or is liquidity challenges we are facing? Okay, let's see what happens in the weeks ahead or the months, in the weeks or months ahead. Let's see what happens on the market. However, just however, the government is still able to cover its maturity obligations despite the low participation at the auctions lately. I just hope we don't get to a time we miss auctions and at the same time we fail to meet to cover maturities, at least not anytime soon. But if it happens, we'll face it. As I said earlier, trading volumes in the secondary market has also doubled this year compared to the same period last year. However, trading activity has been on a downward trajectory this year until July when it picked up and further in August. So when you realize that July and August, the new bonds and old bonds trading volumes have also increased. Is it the case that investor confidence is gradually sneaking back into the bond market, at least the secondary market? I think so. I think but I think most of them too are kind of like repo transactions. So there's a caveat there. When you look at the Bank of Ghana auctions, it has also been declining for a while now, but picked up in July and August. The Bank of Ghana successfully mopped up about 101 billion to the Bank of Ghana successfully mopped up 101 billion so far this year. When you look at the broader equity market, it has also faced some challenges with recent declines in certain indices reflecting both domestic and global economic conditions. So then that is not even a big problem because our equity market is still vibrant and lots of offers are still on the market. I think it is ready to know that the exchange crosses the 90 billion cedis market cap this year. And the Ghana Stock Exchange Composite Index also shows significant growth year to date despite the fluctuations. As of August 2024, the composite index has inched a year-to-date gain of about 45%, and MTN remains the most actively traded stock, which has been a major player with substantial trading volumes on the market. Some of the gainers on the market this year are Unilever, New Gold ETF, GCB, MTN, and Greenwich Ghana. But when you look at some of the stock, also have the price declines and then losses. When you look at, I think, Cal, Societe Generale, and EcoBank, so have some price declines this year, and then are still in the losses. Hopefully they end the year in gains. But when you do the divide, you realize that the non-financial stocks continue to rally against the financial stocks. Have seen in the Black Star. When you look at the Black Star non-financial stock index, It is up about 62% this year, and the financial stock index is still lagging behind with 11% gains. Finally, to the meat and potatoes part of today's presentation. Let me be quite honest upfront. I'm not a banking expert. I am a double in banking, and there's more I don't know about banking than I do. So if I reveal my ignorance, forgive me. But I think let's get going anyway. The Ghanaian banking sector has undergone some several significant crises that have shaped its current state. When you look at in 2008, we had a global financial crisis which impacted Ghana by slowing down economic growth and reducing foreign investment. And this was followed by a severe banking crisis in 2015 to 2017, which was characterized by high non-performing loans and financial instability, which led to bank closures and mergers. In response, the Bank of Ghana implemented some reforms and increased capital requirements between 2018 and 2019, which helped consolidate the sector. Just shortly after that, 2020 came, and then when the COVID-19 pandemic, which further challenged the sector with economic disruptions and also increased credit risks. But banks adapted to digital transformation and liquidity management. Since 2022, the sector has focused on adjusting to inflationary pressures and evolving economic conditions and pushing for financial inclusion and regulatory compliance. And here we are in 2024. What is the difference? How far have we gone? Yeah, in 2024, look at the Ghanaian banking sector. I think it is in the phase of stabilization and growth. When you look at the significant reforms and then consolidations that happened over the past few years, the sector now consists of 23 banks, down from 33 after the crisis we had, and down from a high number. That of course 33. We used to have a lot, but it was reduced to 23 licensed banks due to some mergers and acquisitions that happened and some closures from the banking crisis. 11 of these banks are proudly Ghanaian owned, and then the other 12 have foreign majority interests. When you look at the minimum capital required for banks, it was also increased, and this strengthened the resilience of the banking sector. Just months ago, the cash reserve requirement was also revised. I think Bank of Ghana is really on the lookout to strengthen the sector despite the economic challenges we are facing. When you look at the whole sector, digital transformation has also accelerated in the banking space, with banks increasingly investing in mobile banking and fintech solutions to improve customer service and financial inclusion. However, the sector continues to face some challenges, such as as I said earlier, inflationary pressures, currency volatility, and some global economic uncertainties. As of July 2024, when you look at the banking sector collectively, all the banks together, there was a significant growth in the total assets that are held by the banks. It rose from 30.7% to 349.8 billion cedis compared to July 2023. I think just between December 2024 and in July, the total assets went up only by about 9%. I think this increase was driven by robust growth in deposits. When you look at it, foreign assets also grew by about 38%. Just between 2023 December and July 2024, the cash reserve for the central bank also went up by 35%. Meaning the banks have decided to reserve cash rather than giving out loans with the new CIR initiative that was given in March, because it has reflected in the bank's reserve with the central bank. And when you look at the claims on public corporations, it dipped by 4% in July from December 2023. Deposits with the banks have also seen consistent consistent growth over the years, and that's impressive considering we had just a banking model just few years back. I think it has picked up, and as of July, the total deposits have reached 245 billion. This growth has been driven by primarily by the private sector. When you look at deposits from the public sector, it has remained relatively stable and small. Yeah, it's small, but I think when you look at it, it's relatively stable. Also, it's also worthy to let you know that about 35% of these are demand deposits and mostly non-interest bearing. When you look at it collectively, the banking sector has experienced a sharp increase in deposits, which reflects both the economic growth and increasing confidence in the banking sector. Just to do some banking 101, just before we move to the next session, which is a bit technical, so if you just don't get lost, I would like to remind you or remind all of us what banks actually do. So when I think of a bank, I am thinking of a typical traditional bank, and I try to break its business model down. It just starts with taking in deposits. Customers come in, they deposit their cash with you. Why? Because you offer them convenience, you offer them trust, you offer them safety, and sometimes you offer them an interest rate. So some of these deposits are demand deposits where you don't pay interest and they can take them out at any time. Some are interest rate bearing deposits with terms attached to them where people can still take out money, but then there might be a penalty you have to pay if you are willing to take out your money. So the whole banking business gets started with deposits, which I normally say there's the raw materials for the banking business. So now what do banks do with these deposits? Well, they take those deposits and loan them out to individuals and businesses, charge an interest rate which is high enough to cover the default risks on those loans, and then that interest becomes the income to the banks increasingly. Banks also have the option of investing those deposits in marketable securities or investable securities, usually fixed rate securities such as bonds, and those bonds can range from treasury bonds to corporate bonds to mortgage-backed securities or relatively high rating or low rating. That's if you choose to invest in a low rating fixed rated security, and you may make an interest income on those securities as a bank. So you take on deposits, which you might pay interest in some of those deposits and put that money into loans and investment securities, and you earn money. That spread between what you earn as interest and what you pay out to your depositors becomes a key driving force for incomes for banks. Because from that spread, you have to cover any defaults on your loans, any losses on investment securities, and whatever is left is yours as the owner of the bank. Now, to the extent that banking is subject to shocks where you get unexpected losses, you build up an equity capital to cover those losses. So that's what I think banks actually do. So, but when you look at this surge in deposits, you just wonder, what are the banks doing with this money? Are the banks investing in fixed rated securities, or they are giving out loans? So when you look at what the banks are investing in, they just coming from crisis, but since investors' appetite have increased on the treasury papers. In fact, after the domestic debt exchange, holdings on the T-bills by the banks, that's the collective holdings of the commercial banks, have skyrocketed. When the banks collectively holds about 88 billion cedis in fixed income securities. So a large chunk of the deposits, the raw materials I said, they take have gone into fixed income investment. But when you look at it, it only started declining in March, but this is the net effect after the introduction of the new cash reserve requirements. And when you strip out bonds from the collective fixed income securities the banks are patronizing, leaving only the treasury bills, a bulk of their investment is in the 1 year treasury papers, about 26.998 billion is in treasury papers as of May 2024. I guess they locked in on it 364-day papers to not miss the high risk. However, the trend shows that the 1 year papers have always been their thing. Because when you look at from 2019 to 2020, it reduced. But when you look at it across from 2021 to 2024, you realize that the longer day papers have always been their thing. It's not really, but it just increased, it just skyrocketed in the 2024. Just maybe perhaps because of the high interest rates the papers were offering. I think it is understandable that the bulk of the bank's investment decisions are favoring the fixed income rather than loans. As I said, the banks are either they all have the options to give onto fixed income or give out loans because that's the raw materials they have, the deposits they get as the raw materials, and they have to make something from it. Either give it to fixed income securities or give out loans to customers or other businesses. But I think the banks have really sided with putting bulk of their money in the fixed income securities rather than giving out loans. Because when you look at I think it's understandable that they're actually doing that. Because when you look at the current economic landscape we find ourselves in, it is a risky one to be giving out loans, especially when T-bills offer a relatively high return. Why will you have to give out loans? Because they just can put it in a bill and get back the returns with surety. You don't even have to panic about it. But then we are in Ghana, you have to panic a bit. Yields are high, and I think this is incentivizing enough that the banks have to allocate more of their capital to these securities. And I think the other problem is also liquidity challenges. That is why maybe they are not even giving out the loans as expected. Because with the loans, you can get stuck. So when you look at it, it's actually reflecting when you look at the private sector numbers, I think due to the economic challenges, the banks have become more conservative in their lending practices. The banks are more steered towards investing in fixed credit securities than lending, and it's evident in our private sector growth numbers. The banks are holding back, and this has slowed the growth of the private sector. Although there have been some improvement in the private sector credit, I think it has been slow and negative for a while now because the banks are patronizing safer investments. So all the money is just going into government security, and then just a small portion of it of the divide is going into loans. I think because the banks were not even willing to we're not willing to give out loans to boost economic growth. I think the Bank of Ghana have to step in with directives where that was the new CRR that was introduced in March. So the Bank of Ghana introduced a new cash reserve requirement somewhere in March and linked it to the bank's loan to deposit ratio. This was to push the banks to, it was two options, right? It's either you reserve your money or you give it out in new loans. But then I think the Bank of Ghana actually targeted new loans because that is what was going to boost our economic growth. And then that is one of the most important things we have to look at as a country. But then we're also having issues with this non-performing loans. So the banks are holding back. So the central bank just have to step in and then give out directives. So the Bank of Ghana introduced a new cash reserve requirement and then linked it to the banks to loan deposit ratios. And then it was a tiered system which requires that banks with loan to deposit ratios above 55%, they should reserve 15% of their cash. And banks with loan to deposit ratios below 25% to reserve 25% of their cash. So as of June, from the latest reporting from of the banks for the first half of the year, that's in their financial statements and their financial reports, realized the Societe Generale crossed the 55% threshold and have already booked a swap with the 15% with the Bank of Ghana. And I think this proof further that the banks are not really willing to. Well, this was released, the new CRR came in March, and as of June, it was not actually reflecting. I think this proof further that the banks are not responding to the new measures, the new CCR measures by giving out loans. They're responding by, as we've seen earlier in the earlier slides, by reserving, because we realize that the cash reserves with banks have skyrocketed. It really had a sharp increase. So as of June, for the latest report of the banks, for the first half of the year, so as I said earlier, solely Societe Generale crossed the 55% threshold. And I think this proves that further the banks are not really responding by giving new loans. Which other option the banks would have taken, whether new loans or to reserve cash with the bank collectively, they have to give out about 21.4 billion cedis. We've had discussions about how the banks are performing collectively. It is time to look at them individually, but to be fair and shorten the process, I group the banks into 4 quartiles based on their earning assets. I collectively collected all the banks, their earning assets, what they have and what they have to work with, and then divided them and split them into quartiles. This was just to box them into 4 groups, to be specific, just 4 groups, so that we are able to compare apples with apples, or banks within the same range, so that we are fair to the smaller banks. Hopefully, this levels the playing field. First off, we will start with the first quarter banks, where we have some of the big names: EcoBank, GCB, Stanbic, and Fidelity, and then some others. And then the second quarter banks, where we have some few names, that's Access, Zenith, Stanchart, and CAL, and GT Bank. We also have the third quarter banks, so we have ADB, Societe Generale, Omni BC, UBA, and then Republic. And I'll always end with the 4th quartile banks in all my discussions. Just to reveal some facts about the split. It is based on their earning assets, as I said earlier. From the most recent reports, first half, except for UBA, which was the most recent report I could find for UBA was their 2023 September filings. I will set the table with the first half profits. So for the first half of 2024, consolidated bank profit shot up by a whooping 553%. I think this was due to about 48% rise in their net interest income, almost 53% increase in fee, and almost 53% increase in fee and commission income, and then a 39% growth in net trading income. I think impairments gain more than double. Their impairment gain also doubled, and this lifted its operating income by 47%. I think the bank also improved its capital adequacy ratio to 19.81%, and it reduced its non-performing loans to 11.15%. Absa profit declined because I think most of the significant increase was in their impairment losses in the first half of 2024. And for the quarter 2 banks, CAL profits grew by about 49% in the first half of 2024. But when it comes to CAL, it is important for me to let you know that while the bottom line profits increased substantially, there was a slight decrease in operating income, about 4.4%, and a more significant increase in the net interest income, that was about 24.1%. This suggests that the profits growth was largely driven by activities other than the core banking operation. I think it could be that they improved their efficiency, but I firmly believe that they have capital support. Look at their cash flow statement, you will find more evidence from the proceeds from deposit for shares items. I think they have some capital issues, and then they have support with their right issues and then other sources. So this propelled the first half growth. It wasn't really much of a banking thing that brought that profit, but it was just some capital injection that propelled it. For the third quarter banks, ADB has demonstrated a positive trajectory in its profitability metrics. I think with considerable growth in both net interest and non-interest income, leading to higher profits. However, the bank lacks necessary capital to absorb potential losses. When you look at the bank's capital adequacy ratio, it has dropped to negative 22.9% in 2024. This was a sharp decline from 3.34 in 2023, though it received support from a right issue to boost its capital position. For the fourth quarter, banks, the First National Bank (FNB) has demonstrated notable improvement in net interest income and non-interest revenue and operating income between 2Q of 2023 and 2Q of 2024. However, despite the increase in expenses and impairment charges, the bank managed to turn around its profitability from a loss in 2Q of 2023 to a profit in 2Q of 2024. I think that accounts for more than 100% growth. Also, when you look at Prudential Bank within the same category, it's also a growth in net interest income and overall operating income from 2Q 2023 to 2Q 2024. I think, however, this increase in operating and personal expenses, as well as higher taxation, contributed to a reduction in its profit. Even though we discussed this earlier in the earlier slides, we have to look at the taking this time around with a focus on just a few banks and how they compare with their peers. For the first quarter banks, when you look at the loan to deposit ratio rate, it seems that AMSA is the most aggressive in terms of loan allocation, and CBG is the most conservative. And CAL, when you look at the second quarter bank, CAL is the most aggressive in its lending approach, while GT Bank is the most conservative. Access SCB, that's Standard and Zenith Bank also exit moderate to cautious lending strategies. Whereas when you look at the fourth quarter banks, the third quarter banks, Societe Generale is the most aggressive in lending, while Omni Basic is the most conservative. Republic Bank and ADB have a moderate lending strategies, and UBA is also cautious in its loan allocation when you look at their loan to deposit ratios within the same quarter. Among the same quarter banks, when you look at the four quarter banks, Bank of Africa and then FNB are the most aggressive in their lending practices, while UNB and First Atlantic are the most conservative. Just remember that I said earlier, UNB, we are still using their 3Q September of 2023, that's 2023 numbers, so it's not really reflective of their current records. The most recent filing we found for UNB was in 3Q of 2023. Prudential and FBN have moderate lending strategies. So we look at their loan to deposit ratios within the same group. Let's look at how was the lending terrain in the first half of 2024. Did the banks manage their loan books well? I think I've given hints in my previous slides. We'll have to discuss it more further. This has always been a problem of banks, the non-repayment of loans. So that's really discuss it. So when you look at the first quarter bank, Fidelity and CBG have the lowest levels of non-performing loans. I think they suggest they are managing the asset quality compared with the others. Fidelity's non-performing loans even increased by 62%, but remains the lowest within the second quarter, but started between 2023 2Q and 2024. Increase about 60. Their loan books increased about 62%, but still remains one of the lowest within the quarter one banks. While GCB has the highest non-performing loan ratio, and they even dropped like 1.5% in Q2 of 2024, but still the highest. When you raise a pause, compound non-performing loans increased dramatically to 38.6% in 2024 from 12% in 2023. I think this high level of non-performing loans suggests serious issues with the loan quality and could lead to significant credit losses. Even at the time, the bank's capital ratio dropped to 7.3 from 10.1% in 2023. That is worrying. The bank also disclosed that they have some other regulatory challenges. When you look at their filings, their reports, and you go to their risk disclosures, you realize that the bank has also disclosed that it has some other regulatory challenges it is facing in the first half report. But that's a topic for another day. Within the same quarter, Zenith Bank reduced their loan books, the NPL books by about 55%. UBA shows the healthiest asset quality within the third quarter banks. Just between 2023 first half and 2024 same period, they managed to reduce their loan books by almost 45%, while ADB has the highest proportion of non-performing loans within the same category. I think the surge happened in the first half of 2024. The non-performing loan books ballooned by more than 100%, almost 120%. When you look at the fourth quarter bank, FNB starts out with the lowest level of non-performing loans. I think this is interesting because their non-performing loan books grew by 170%, way above Prudential, for still the lowest in the same category. But Prudential faces the most substantial challenges with the highest NPL ratio within the fourth quarter banks. Now, how well are the banks controlling their operating expenses relative to their income? Are they cost efficient, or there is room for improvement on efficiency, or they need some external support? There is no more capacity to explore. Well, within the first quarter banks, ABSA appears to be the most cost efficient, while CBG may need to focus on reducing or improving its income generation, because 78% is pretty high for a bank. Within the second quarter banks, Access leads in cost efficiency with a cost to income ratio of 29.8%, followed by Zenith 34.3% and GT 34.3%. Stanchart and Carl have moderate efficiency at 36.6 and 37% respectively. Access is the most efficient among this group. When it comes to OmniBiz and UBA, they also demonstrated exceptional cost efficiency with cost to income ratio of 10.7% and 14.9% respectively. I think ADB also shows moderate efficiency at 30.9%, while Republic Bank Ghana has a ratio of 46.5%. I think Societe Generale lags significantly with a high ratio of 72.3%. And to the fourth quarter banks, I think UNB and First Atlantic Bank have shown strong cost efficiency with cost to income ratios of 10.7% and 14% respectively. Prudential and FBN are also efficient with ratios of 18.5% and then 18.1% respectively. When you look at FNB, it has a moderate ratio of 38.7%, while Bank of Africa is less efficient with a ratio of 47.6%. And when you box this discussion so far, when you put everything together, 1 to 1, 2 to 2, when you put everything together, what do you think about the banking sector? Is it showing resilience? Are we on a path to full recovery, or there's still a long way to go? Because when you look at the banks collectively, we look at it collectively from the start, and then in the middle, we looked at it individually, and now we are going to look at it again all together to see what is actually happening. Whether we are really showing resilience, or are we on the path to recovery, or there's still a long way to go? When you look at the capital adequacy ratio of the banking sector, it remains positive. It is comfortably above the regulatory minimum of 10%. I think this means the sector as a whole is well capitalized and have enough cushion to absorb any potential losses. And that's if we are subject to any unforeseen institutions. I think this signals resilience enough. Though kudos to the Bank of Ghana for coming in to support the mayor, and though the past few months it dropped. And when you look at the cost efficiency of the sector as a whole, and you look at the cost to income ratio, as as of June 2024, it is below 50%. I think now we need to improve and come down to lower levels. This increase that it indicates that the Ghanaian banks are managing the operational expenses better with a healthy level of profitability relative to their costs. I think this is an improvement from the previous periods and suggests an increased operational resilience. And then when it comes to the collective non-performing loans of the sector, it is concerningly high. It is one of the challenges. I think the NPL, the non-performing loans of the sector as a whole, as of June, is 24%. That's pretty high for the sector. And while the banking sector have adequate capital, high non-performing loans reflect challenges in asset quality and could lead to future risks if not managed properly. I think this is a pushback to the resilience of the sector. And when it comes to liquidity, when you look at the liquidity ratio, it's around like 43%. I think this means that the banks have a solid buffer a buffer of liquid assets to cover short-term liabilities. And the sector is well positioned to meet its short-term obligations without facing liquidity constraints, which is crucial for their resilience during the financial stress. And when you look at the sector's profitability, I think when you look at it has a very high return on equity of about 35.23%. Yeah, and this reflects strong profitability. The sector is generating significant returns for their shareholders, which signals that they are efficiently using their equity to produce profits. This level of profitability boosts investor confidence. I mean, they get something from it if you invest in banks, and this adds to the sector's resilience. And when you look at the sector's total asset growth position, the total assets position it has grown by 15.5%, and total deposits have also increased by 16.6% as of June. This robust growth indicates that the banking sector continues to attract deposits and expand its balance sheet, I think, which is also a positive sign for resilience. To draw the curtains to today's session, so when you look at Ghana's banking sector, it shows resilience in several key areas. I think particularly a strong capital adequacy ratio, improved cost efficiency, and a high profitability as indicated by the return on equity. But however, the high non-performing loans remains a significant challenge, which poses risks to asset quality and the long-term stability of the sector. I think continued management of credit risks and improvement in the loan performance will be a thing to look at and improve to further strengthen the sector's resilience. As I said earlier, everything I've said is in this session comes from the perspective of somebody looking from the outside, someone from the outside looking at banking. And I'm sure that there are banking experts who would set me right on things I've misstated. Thank you very much for listening, and I hope you found this session useful. Take care.
Thank you very much, Gary, for the insights shared this morning. At this point, the floor is open for any contribution, reactions, or questions from all participants. Kindly note that your mics have been allowed, so you can easily lift up your hand for you to be called, for you to express your views on the presentation or your contributions in relation to what has been presented by Sunkari. If you are not too comfortable letting us hear your voice, you can make use of the chat box or the Q&A box. Okay, whilst we have people thinking about their questions, maybe we can quickly run the poll. I'm sure by the time we are done with the poll, people would have captured their questions or finished typing their questions into the chat box. So I would entreat us to just spend about 2 minutes answering a few poll questions based on what has been presented today. So the polls are categorized into 3 sessions. We have that of the macros, and then we have one on currency, and the other last part would be on the banking sector as presented. So we have two questions in this first session here. We are asking, after July's inflation rate declined to 20.4%, what is your estimate for the inflation rate in September? There's a second question in there, which is asking about your forecast for inflation by the end of the year. Second set of questions is on exchange rates. So we would like to find out from you what your forecast for the exchange rate is, given the cedi's year-to-date depreciation of 23.68%. Questions in here. First, we would like to know from you how confident you are in the stability of Ghana's banking sector post the economic distress. To the next page, what do you believe will drive future growth in the Ghanaian banking sector? Do you think an increase in private sector credit will do so, or improvements in regulatory policies will do the magic, or technological innovations will lead to the breakthrough, or foreign direct investments? All right, so as we found out from the presentation, what is your view on the current loan to deposit ratios of banks? Is it satisfactory and manageable, or you think it's high, indicating a credit risk, or it's low, signaling underutilization of deposits, or you don't have any opinion on the current loan to deposit ratios of banks? The fourth in this session, what is your assessment of the regulatory framework governing banks in Ghana? Is it robust and supportive? Is it adequate but could be improved? Is it weak and needs significant reform, or you're unsure? The next question would like to solicit your perspective on the current state of digital banking in Ghana. We say the fourth industrial revolution is being led by technology and AI to an extent, and we've seen all the banking institutions all actually adopting technological innovations. So we would like to find out from you what your perspective is on the current state of digital banking in Ghana. Is it advanced and well integrated? Is it still at the developing stage with potential for growth, or you think it's underdeveloped with many gaps, or you probably unsure of it? Now to the penultimate question, we would like to know what your opinion is on the role of government support for the banking sector. Is it essential and highly supportive, useful but not crucial, or minimal and ineffective, or you are unsure? And finally, what is your view on the level of transparency in the financial statements of banks in Ghana? Highly transparent and reliable, generally transparent with some issues, low transparency and requires improvement. Okay, so that brings us to the end of the post. And let me remind you that this is anonymous, so your names wouldn't show. So you can feel comfortable whilst answering some of these questions. If you missed any of the questions, you can easily scroll back and then share your views. Now back to the floor being open for reactions, contributions, or questions to our presenter. Does that to mean we all agree with what our presenter said in this presentation? Or too much information to digest within these few minutes? Probably you would need time to take a second look at the document, then probably the conversations or the engagements could follow upwards. Okay, looks like Sunkari, you've done a great job. We all understood it and enjoyed your presentation. Thank you so much for the insights. You've given us a comprehensive overview of market dynamics, inflation trends, currency trends, and a deep insight into the banking sector, as well as the market updates taking into consideration fixed income, treasury bills, and equities landscape. We are grateful for your time. We thank all participants for your time as well. We thank all participants for your time as well. But before we wrap up, let me just chip in this. Just reminding you that Blackstar Group is a proud primary dealer and a key player in the secondary market. We are open for business across both fixed income and equities markets, offering a wide range of services to you and your clients. We also maintain a strong presence in the global asset space, providing non-CD investment alternatives for those who would like to diversify outside of Ghana, like Euro bonds, US Treasuries, UK gilts, supranationals, and other foreign equities through ETFs, mutual funds, and index funds, or individual stocks like Apple and Co. For those interested in fund management too, we manage some of the highest performing mutual funds on the market, including our enhanced equity beta fund, which has an offshore tech equity bias and leads its peers. We also offer a range of funds like the Fixed Income Alpha Plus, the CCMF, Plus Income, and Plus Balance funds, which are available for you to explore. Our investment banking desk also has a proven track record of delivering exceptional services, and we are here to support you with all your financing needs, valuations, and other related mandates. If you want more of this information, like what we've presented to you today, you can always follow us on our social media platforms at Blackstar Group, where we frequently share valuable insights into market trends. And our weekly chats are also very insightful. You may want to consider. You can also find us on YouTube to enjoy some of these videos, which the link would be shared there. Feel free to reach out to us via phone or email for any further inquiries. My name is Ernest Edu Owusu. I was a moderator for today. Our presenter for today was Enoch Sunkari, an instrumental member of our research and analytics team. For those joining us for the very first time, Market Color comes up every third Tuesday of the month, so you can make time with us next month. Thank you very much. Until we meet again, have a great business day. Bye-bye.